We turn our books on pages 255. That is for those who are having derivatives analysis. That is a revision kit. Is page 255. We still have those students who are taking advanced financial management. You turn on to page 395. That is your study text. The question that we want to attempt, you find it in those pages respectively. That is for derivatives analysis. Those who are taking CFA or CIFA, you find that question in page 255, revision kit. And for those who are taking advanced financial management, it's page 395, study text. We are still continuing with our discussion from where we left last time about the Black-Scholes model. I believe the last discussion that we had, I think yesterday, most of you were able to understand how to calculate the call price or the call price of a bond using the Black-Scholes model. Now we want to continue with the same discussion today, and as we mentioned last time, we gave the meaning of Black-Scholes model, and as you can see from your screen, and it's the same definition that you have from those respective pages that I have told you, is that because I want us to move together to save time, because already you have all the ideas concerning this concept. As you can see from the screen, we've said that the Black-Scholes model, now there are those who pronounce that one as the Black-Scholes, but others pronounce it as the Black-Scholes model. Is the same thing, is the same person, it's the name of a person. So when I say Black-Scholes model, others say Black-Scholes model, we are talking about the same person, the same concept. Is the name of a person who came out with this concept. There were 3 people actually, and I believe all of them received Nobel Peace Prize some times back. You can just read more about their biographies or their autobiographies or whatever they achieved in the field of finance and investments. So the Black-Scholes model is a mathematical model used to determine the theoretical price of European-style options. It's one of the most widely used models in finance, especially for pricing a call and put options on stocks that don't pay dividends. So we can use it to price the call or put. Now you have to differentiate between a call and a put. As I will mention in a while, I'll differentiate for you what's the difference between a European call and European put. Now, the formula for European call option, you can see, just as we did last time, here, C is equals to S subscript or S naught times, now this dot is times N D1. I showed you how to calculate D1 and then how to get N D1. Once you calculate D1, you should be able to read the number from our binomial tables. So to calculate C, or the call option of that is European call option, because you have European call option and European put option. Now call means to buy and put means to sell. So to calculate the European call option, C, which is a call option price, is equals to S subscript, that is current stock, times ND1. I showed you how to calculate D1 and how to get the entire number here from the table, minus K. K is the strike price of the option, times E, exponential function. It's also called espionage. I think the person who came out with that number was known as espionage, but again, we call it exponential function, which you can get it from the calculator. And I think I showed you how to calculate that E there, espionage. You just pick this number, you go to your calculator, you press here, this one here. That one is equals to that. Espionage, you have to shift the alpha there, then you come here. You pick that, you can see what is appearing there in the calculator. E, espionage, or exponential function, is equals to 2.7182, that way. So that one you'll be calculating within that. So K, which is strike price of the option, times espionage or exponential function raised to rate times T. Rate here is a risk-free interest rate times T, the time to expiration. Then you multiply by N D2. We'll be able first to calculate D2 and then we read the number from the table. That is something that we did last lesson. Now we continue. Now note that even though that today we are discussing how to calculate C or the call option price using the Black-Scholes model, I want us for today to do the European call option, so that maybe next lesson I'll do an example for European put option. However, I have put the formula there for you. So before we meet next time, I want you to study this formula here, how to calculate the European put option using the Black-Scholes model. Now, the explanations are here for whatever appears in that formula. Now here C, we have said C means call option price. S subscript or S note is a current stock price. Then we have P, put option price. Then K, strike price of the option. T, time to expiration in years. R, risk-free interest rate, that is per year. Then here we have volatility of the stock or the standard deviation of returns. And then any D1 can be D1 or D2, whichever. Can either be N, D1 or D2, which is cumulative distribution function of the standard normal distribution. Now let's see. So once we calculate D1 and D2, we should be able to calculate either C or P, that is the call option price, or P, that is the put option price. The most critical part is first to calculate D1 and D2, then we obtain ND1 and ND2 from the table. So let's check the formula again for calculating D1. You have the first number here, which is natural logarithm. You have it in your calculator. Then you'll be taking current stock price divided by strike price of the option. You first deal with this part alone. You can have it alone separately. You get one number. Then plus R, risk-free interest rate. You plus volatility of the stock, which is the same as the standard deviation. If you square standard deviation, you get the variance. So you square the volatility, then you divide by 2, then you multiply by t. T is a time to expiration. Then you divide by volatility of the stock multiplied by the square root of the time to expiration. That is how you get the D1. Now, once you have known how to get the D1, the other thing is obtain D2. D2, you just pick D1, the one you have calculated above here, then you minus the denominator, the volatility of the stock times the square root of t. You can see is what you have done here. So once you have calculated your D1, you just need to minus this number you have here in our formula for D1. As you can see, we are saying D2 is equals to D1, which you have calculated up here, minus volatility of the stock multiplied by the square root of t. Now, something that I want to show you from your calculator, the natural logarithm is this number which is here, that way. Just one, not several times, but only one, that one. So you just input that you press in here, you press in that button, then you put the brackets. Put the number you want, divide by whatever you want there. That is according to the question. Then you get your answer there for part 1. Now, once you obtain your D1, there is something very important that I want to mention here about the difference between European call option and European put options. Now, you have said there that the difference between European call option and European put option lies in what right the option gives to the holder. Note that a call means to buy, put means to sell. So see there, European call option gives the holder the right but not the obligation to buy an asset, e.g. a stock, at a specified strike price on the expiration date. You use a call option when you expect the price of the asset to go up. So you buy. We are saying if you expect the price of an asset to go up, obviously you buy that particular asset immediately. Because if you wait for the price to go up, you end up paying more. If, for example, the asset is selling at 100 and you expect the price to go to 150 within a few days, it is advisable as an investor to purchase that asset today at 100 so that you don't purchase at a higher price. So that is the meaning of that statement there, that you use a call option when you expect the price of the asset to go up. So we have said that European call option gives the holder the right, but not the obligation. Remember, you have no obligation, it's just a right to buy an asset. Then European put option, we have said put means to sell. So what have you said down there? It gives, that is, European put option gives the holder the right, but not the obligation to sell an asset at a specified strike price on the expiration date. You use a put option when you expect the price of the asset to go down. It is the opposite of the European call option. Because if you expect the price of the asset to go down, you sell immediately. Because if you wait, then when you sell, you lose. If the price of an asset today is shillings 100 and you expect the prices to go down to 80 shillings within a few days, it is advisable as an investor to sell today at 100 shillings, because if you wait for the prices to come down at 8, you'll be losing 20 shillings. So what you do is that you sell today immediately, because you are anticipating the prices to come down in the near future. That's a major point which I wanted to clarify, because some of you were asking me what's the difference between European call option and European put option. The difference is just call, the term call here. You can see here is European, here is option, here is European, here is option. The difference is only what's the difference between call and put. I've said call is to buy. A call means to buy. A put means to sell. So when am I supposed to buy and when am I supposed to sell? The decision depends on your expectations in terms of if the prices are likely to go up or the prices are likely to go down, depending on whether you are the buyer or you are the seller. So make sure before we take our example, you understand this formula here, which we didn't last time. This how because we are in this question we are going to do an example which is illustrating the calculation of a call option price using the Black-Scholes model. And this formula is very important. What you can see here, as I have told you, and I think we did it last time, you understand all what is here. And then this part here is very important, is what we're going to do there. Then try to understand how to calculate D1. I've told you we first deal with this part and then we sum up with the other part. D2, we have calculated our D1, then we minus that part there. Now we can move to next page. You can open the next page. Open the next page. But before you move to the next page, make sure you understand this part. Make sure you understand this part. You can write it somewhere. Not this part, but the first one. Because you are calculating European call option. We are calculating the call option price of for European call option. So this is what you need for now. And then this part here, how to calculate D1 and how to calculate D2. So once you have that, not only having that portion and also understanding it clearly, then you can move to the next page. Right, I'm there. I am there. I'm giving an example there whereby I'm told that calculate the price of European call option with the following inputs. You have the parameter. The first one is current stock price. That is S subscript shillings 100. Strike price, abbreviated as K, shillings 105. Time to expiration, abbreviated as T, 1 year. Risk-free interest rate, 5%, which is 0.05. Then volatility, 20%. You write it in decimals, 0.20. Now, remember we are calculating the price of European call option, having been given these inputs. So step 1, there are 3 major steps. I believe if you understand these 3 steps, you will not experience any challenges as far as this particular section is concerned. Now step 1 is you calculate D1 and D2. The formula is here. The natural logarithm, which is in your calculator. Then you close the brackets. S naught, that is current stock price. In our case, it is 100. You take 100 divided by K. Strike price is 105. So you press the natural logarithm, open the brackets. You put 100 here. divided by 105, then you plus R, the risk-free interest rate, then you plus volatility 0.2 squared divided by 2, then you multiply by T. T is the time to expiration, which is 1 year. The answer you get up there, you divide by volatility 0.2, then square root of T, which is 1. Now, as I told you, you are supposed to take one part at a time. So what you do is that you take this part. I think I showed you last time, and I think you have no challenges with that. So what you do is you just pick a natural logarithm here, then open the brackets. You open the brackets, then you input 100 over 100 over 100 divided by 105. 105. You close the brackets. And you get negative 0.0488. So that's how you go about that. This section here, you get negative 0.0488. Now this part, I think you don't have a challenge here. You just take 0.05 because that is our risk-free interest rate, 0.05. You plus volatility, which is 0.2 squared, 0.2 squared, this one divided by 2, then you times 1, time to expiration, which is 1 year, divided by 0.2, 0.2 is the volatility, this one here, square root of T, which is 1. So if you work out all this, now the first part I have done it for you. I've shown you how to use your calculator to get this part here. You plus this part here. This one I don't expect you to have a challenge. If you work out that, you get 0.07 divided by 2. 0.2 times square root of 1. Square root of 1 is just 1. So the denominator here will be 0.2. Will be 0.2. Now let's have that. I believe you will have done this part correctly. Just work out this one. You work out that part first. Then D1. This is D1, and this is D2. Now this D1 and this, D1 is here, 0.106. You can work out this part to see whether you are getting this number. Then D2, we have said D2 is gotten by D1 minus volatility times square root of T. This part here we have done before, which is, now this number here has a slight error. So this figure should be 0.2. This part here, this is not 2, this is 0.2. This should be 0.2. So I think you can rectify that. So D1, this is 0.2. I've rectified that. 0.2, not divided by 2, because 0.2 times the square root of 1 is 1. So the denominator is 0. The denominator is 0.2. So D2 is given by D1 minus the denominator here, whatever you got here, which I believe is 0.2. You minus that, so you are getting 0.106 minus 0.2, you get negative 0.094. So that is our first step, establishing or calculating D1 and D2. So this is our D1 and this is our D2. Step number 2, you find ND1 and ND2. Now I showed you how to use your standard normal table to calculate ND1 and ND2. If I think I'll not go back to the table because I showed you in the last last video. You can maybe check from our YouTube how to use the standard normal table. It's very easy. You can find it here from our previous lesson, Fatima Institute. You get it from there. What you did 2 days ago. How to get ND1 and ND2. You see we have D1 is 0.106 and D2 is negative 0.094. So you're just going to the table, you read these numbers, you find them there. So we have our ND1, this is our ND1, and this is our ND2. Now lastly, the last step is to plug into the call option formula. Our formula. I believe you have not forgotten. The formula. Let me remind you if you have forgotten what you want. Remember, we have said first we need to calculate D1, D2, ND1, ND2, and all that. For a routine call option, our formula is there. S0, that is current stock price, you multiply by ND1 minus strike price of the option times this part I've told you is exponential function raised to negative R times T times ND2. So we just want to plug in all these numbers, whatever you have, and then you'll be able to get the price, the call option price. All right, now let's go to the other side now. You just plug in, as you have seen from the previous page, C is equals to 100. Now 100, we know, is a current stock price times 0.542, that is a ND1, minus strike price multiplied by E. I've told you what is E. Is exponential function raised by negative T times R. Our R is risk-free interest rate, 0.05. We multiply by T. T is 1 year. So it is the same as taking our espionage, which is R, negative R. Our R is 0.05. Now this is a negative number, 0.05. We take espionage first. Espionage, we take it from there. Espionage raised by negative 0.05. We get 0.95, 0.9512, something like that, what you can see here. So that is what we have tried to explain here, 0.9512. Then once you get that, the other part is just you continue substituting. You have taken 100. 100 we have said is a current stock price times ND1, 0.542. We minus strike price 105 times exponential function raised to negative rate times T. T is 1. Rate is 5%. 0.05 negative times ND2. ND2 is here. You work out that, you get shillings 8. So we have calculated our C as shillings 8 in that particular question. Right, that is how we go about that. Now the next question, you can just go through that particular question that you have done. You see whether you are able to understand the concept, what you have done. And then if you have a challenge with this particular question, you can just check from the last 2 days question that we did concerning this concept. I repeat that as far as the Black-Scholes model is concerned, we are supposed to understand 3 formulas, very important here. How to calculate call option price? The formula is here. How to calculate the call option price and how to calculate the put option price. Understand how to calculate D1, D2, then how to read the ND1 and ND2 from the table. You can as well calculate the values using your calculator. I think I showed you some times back how to calculate those values using your calculator. Okay, so that is all about that particular question. Now I wish to leave you with some questions. I want to give you some questions to attempt, if possible. If you'll be able to attempt these questions, if you will be able to attempt those questions, I think if you go to page 234, that is for CIFA. If you have the book for CIFA, derivatives analysis, there's a question there. There is a question there that I want to give you as an example. You can take it, you can just check 234. I think that can be a good question for your revision. You are told, I'm not doing it for you, but I just want you to go and try to see what you have done there. You are told the following information relates to a certain Kenyan-based listed company for the year 2023. Stock price, shilling 62. Exercise price, shilling 60. Time to expiration. Now this is not shillings, this is 40. 40 days. We divided 40 over 365. Then volatility, that 2%, which is 0.32. Risk-free rate, 4%, which is the same as 0.04. Required value of the call option, and number 2, value of the put option. This denominator is very far. It's supposed to be at the center here. Should not confuse you. This is our denominator because this is volatility times square root of t. That is this volatility here, 0.32 times square root of, you divide 40 divided by 365, square root of that, then you work out D1. This way, what you have done down here. Then once you get your D1, get your D2. D2 you have said you just take your D1, which you have calculated. I see it is the half here, minus volatility multiplied by square root of t. We have done that. We got 0.3. Then the values of D1 and D2 can be obtained from the standard normal distribution table. You can see this is what we got. You can check from your normal distribution table to confirm these figures, because D1 is 0.4, which you got up here, 0.404. Check from your normal distribution table. Then ND2, you are getting it from the D2. We got D2 0.30. After reading that, you get 0.6179. Then value of the call option, you just need to substitute the numbers you have in your formula. And then the last part, even though we have not done that particular formula, I have shown you the formula. For value of put option, but you can try that before we meet tomorrow. The value of the value of put option. You can see there the value of call, we got shillings 73.72. Then we have value of the put option is calculated down there. Then maybe I can give you another question for your practice. I can give you another question for practice, maybe page 249. Page 249. 249, you can get a question there. The questions, you find them in the derivatives analysis book, not for CPA. There's a question there whereby you are told the following information relates to a call option on Bendera Limited's shares trading at Securities Exchange. The exercise price is shillings 70. The risk-free rate is 6%. The volatility is 0.4. The days to option expiration is 90 days. The current share price is shillings 60 required. The price of a call option on Bendera Limited's shares using the Black-Scholes-Merton pricing model. You can see the formula for BSM is given as follows. You can see it there, how they have given that, D1 and D2, just as we have done before. So I think you can attempt those two questions which I've given you there. Even though the solutions you can see the solutions there. You can try to see whether the answers are in agreement with what you know and what you have learned today. Now, the last part for our lesson today is we have a section after every lesson where we receive questions from our students asking about general questions about finance. And if you want to send a question, any question in general, if it is can still be concerning your examination, or any question, any general question, whether it is concerning the economy, listed companies, the governments, anything to do with finances, you just send to us through our number there. That is, you can see down there, our number there, plus 254 if you are outside Kenya, plus 254 727 87 10 93. So if you are out of the country, you start with plus 254. If you are in Kenya, just write 0727 87 10 93. Now, we received this question from somebody. I don't know whether this was a student or this was just somebody was interested with this particular financial matter. Is asking this question. So this is a question for today. There's this person called Ramadan who is asking this question. Is in Kenya. Kenya's debt is at shillings 11 trillion as at today, the year 2025. Why can't the Central Bank of Kenya print this amount and pay the lenders immediately? Now that's an interesting question, that the debts in our country is 11 trillion today. He's asking. I think what he has in mind is that it is the responsibility of the Central Bank of Kenya to print and mint currency. Why do governments complain about debts and they have the capacity to print money and pay immediately? That's a good question. Now let me answer you, Ramadan. Your name is Ramadan. Now, the reason why the government cannot print money and pay the foreign debts is because, one, and here we are specific because you are asking a Kenyan situation. The reason is because these loans are borrowed in terms of dollars. The Kenyan government is only able to print Kenya shillings. So the government of Kenya does not print other currencies like dollars or maybe euros or Japanese yen and other currencies for other countries. The government of Kenya is only able to print Kenya shillings. So these loans are obtained in terms of foreign currencies, specifically dollars. So we have to pay in terms of dollars. So what we do is that we are supposed to use our own currency, that is Kenya shillings. We purchase the dollars, then we pay the debts using the dollars. That is one of the reasons why, or it is simply the reason why we cannot print money and pay the debts. The other reason is that because I think you are asking, why can't we print and pay the 11 trillion immediately? Now, it is not, these debts is 11 trillion for sure, but these loans are not falling due within this year. Part of it, the government is only concerned with that portion of the 11 trillion which is falling due within the course of the financial year. That is a 2025, 2026 financial year. That is the only concern for the government. And it may be a very small proportion. Maybe out of the 11 trillion, it is only 4 trillion or 5 trillion which the government is supposed to pay within its financial year. So that is a major concern. Because some of these loans have maturity of up to maybe 10 years, 15 years. So part of the 11 trillion, maybe there is that portion which should be paid after 5 years or 6 years. So we don't need, the government does not necessarily need to pay the 11 trillion this year. It's paid in terms of phases. That's the reason. So I think you're asking, I think I've answered you that way. And again, the cost of printing currency is quite expensive because you ask yourself, how much does the government spend to print 1 shilling or 0.5 of a shilling? It's more expensive to do that job. Printing the currency is also quite expensive for the government. So it has to utilize the amount or the money that it already have in circulation to pay for those debts. The other reason is because, again, printing too much currency may also bring about inflation. I think you have done inflation in economics, where you have a lot of money in circulation, and then there is a problem with the economic status of that particular country. Then lastly, I'll just answer 2 questions for today. Then the last person there is Ishmael. Now Ishmael had sent this question within the course of the day, was asking, can the government tamper with the exchange rates to loot the public coffers in the name of paying foreign debts? I think he's asking, can the government tamper with the exchange rates to loot the public coffers in the name of paying foreign debts? That is Ishmael. That is what he's asking. Now, I think what Ishmael is trying to ask is something to do with what is the effect of obtaining foreign debts when the currency for the borrower is at a particular exchange rate, and then in the future this rate goes up or goes down. What is likely to happen? Now, I think you are not asking the effect of that, because if you are asking the effect of that, for example, I take an example. If today $1 is exchanging at shillings 100, and we get a loan of say $1,000, and we are paying next year, if that exchange rate does not change, obviously we will pay shillings 100,000, because $1 is the same as shillings 100. Then a loan of $1,000, if you convert $1,000 into shillings, we get shillings 100,000. So if the exchange rate remains the same, that is $1 is equals to shillings 100, and after 1 year that exchange rate does not change, then we will pay shillings 100,000. However, what will happen if $1, that is after 1 year, when we are paying this loan, $1 is exchanging at shillings 150, that is instead of shillings 100, how much will you pay? Because $1 is equals to shillings 150, what about 1,000 shillings? That translates to shillings 150,000. So if the currency has lost value, that is, you can see, if you compare the first example that I'm giving you there, that is from $1 is to 100, then it moves to $1, shillings 150, then instead of paying shillings 100,000, the government will pay shillings 150,000. So we have lost 50,000 shillings when the exchange rate changed from shillings 100 to shillings 150. What if the opposite happens? What if this exchange rate moves from shillings, that is $1 is equals to shillings 50, to maybe $1 is equals to shillings 80 in the future? So we will not pay shillings 100,000. You pay shillings 80,000. So we are likely to pay a lower figure when this exchange rate changes. That is, if the currency for the borrowing country is getting stronger and stronger. Now, in that case, the government is likely to save. But you are asking, what you are asking is, I remember your question, I think you are asking, government, that is, can the government tamper with the exchange rates to loot the public coffers in the name of paying foreign debts? Now, what I can say is that because most of these borrowings are agreements between governments and maybe foreign countries and foreign lenders, most of the information may be missing from the members of the public, because some of these agreements may be secret, and we may not be able to know some of those agreements, what they say. So governments run by leaders who have no morals or ethics, and most especially those countries with very weak laws and institutions to protect the public funds can collude with the national treasury and the central bank to do so. That is what I believe. As I have told you, that because the exchange rates, we usually say that they are determined by the market forces of demand and supply. But sometimes the National Treasury and the Central Bank of Kenya can manipulate these exchange rates. We can get a loan of maybe 1,000 shillings, as I've told you, $1,000, when the exchange rate is at $1 at shillings 100. That means if you translate that into shillings, it comes to shillings 100,000. So it means that in the future, if that exchange rate remains the same, if our loan was 100,000 or $1,000, you pay 100,000 shillings. But there is that risk, because that is what you wanted us to clarify. There is that risk that because you don't know the agreement with the lender in the foreign country, or the Bretton Woods institutions like the World Bank and the IMF, then the government may maybe adjust the exchange rates so that the exchange rate goes up from $1 at 100 to $1 at shillings 150, and therefore we lose 50,000 shillings in that case. But what the lender is paid is shillings 100,000. So the 50,000 will be taken by some corrupt members or corrupt people in the government. That risk is there, but I don't know. I just want to say I don't know whether it is possible to happen mostly in those very strong countries where corruption is not entertained. But that risk is there. But there must be a lot of collusion between the government officials and where maybe the Auditor General is compromised. So those were the two questions for today. And one was coming from Ramadan, who was asking, Kenya's debt is at shillings 11 trillion as at today, the year 2025. Why can the Central Bank of Kenya print this amount and pay the lenders immediately? So I've given you the clarification for that. Mr. Ramadan, I think you have understood my answer. And the major reason that I've given you is that this money is borrowed in terms of dollars, and the Kenyan government can only print shillings. So the government can only use the shillings that they have to purchase the dollars and pay the loan. So it is not possible to pay the borrowed funds using Kenya shillings. And then the last question was from Ishmael, who was asking, can the government tamper with the exchange rates to loot the public coffers in the name of paying foreign debts? I've said that risk is there. That risk is there. And I think it must be a very high level of manipulation, what we call creative accounting, maybe to loot from the public coffers. So that is the answers for the two questions that came from some of our students concerning the general knowledge about finances. So if you have any general question concerning finances or finance and economics, we just gave a number there, that is plus 254 727 87 93. So we come to the end of our discussion for today, and today our major discussion was about the Black-Scholes model. Was a continuation of what we were doing 2 days ago, and we have done the European call option and European put option, which I will attempt maybe next lesson. We have done how to calculate D1, how to calculate D2, how to use our table, and then we have done an example here. So up to this level. So I think that's now for today. So we'll meet next time. Now this discussion will continue about derivatives. We're also dealing with other subjects. You'll still be getting them as time goes on. So you can subscribe there, down there. You can like our video, subscribe there, make a comment. Where we are wrong, just mention. You feel free to mention where we are wrong. You also feel free to congratulate us where we are right. And again, you can send the question for today. We will read it and you answer it for you. And the numbers are here. You can just write an SMS there, or you just write your question in our YouTube channel down there, where you'll be making your comments. My name is Mr. William. Have a good night. Thank you.